Hello everyone, welcome to the subject F7. Today we will be learning about borrowing costs. Now, borrowing costs is under IAS 23. When you first hear the word borrowing costs, what are you thinking about? Well, maybe interest payments? Yes, borrowing costs is actually the cost that we pay when we borrow money. Now, let us look at the ACCA definition of borrowing cost. Okay? Interest and other payments incurred in relation to the borrowing of funds. Yes, when we borrow funds, we have to pay something called interest. Now, this interest, we usually expense it off in the profit and loss under finance costs. But IAS 23 allows us to capitalize borrowing costs, meaning we can put it as the cost of the asset. Okay? We do not expense it off again now, but we will capitalize it. Now, this is not applicable to anything that we use the money for. This is only applicable to self-constructed qualifying assets. Okay? Now, you might be wondering, what are qualifying assets? Okay? Qualifying assets are assets which take time to get ready for its use, meaning it is assets which take long to construct in this scenario. Yeah? Now, here are some examples of qualifying assets. Okay, first we have is inventories, intangible assets, investment properties, power generating facilities, and manufactured plant. Okay? Now, let us review so far what we have learned. When we want to self-construct a qualifying asset, we sometimes do not have our own resources. Now, when we do not have our own resources, one option is to borrow funds. When we borrow money, we usually have to pay something called interest payments. IAS 23 allows us to capitalize interest payments, meaning we do not have to expense it off in the profit and loss. But the interest payment is added to the cost of the asset. This is what we're going to be looking at under IAS 23. Okay? Now, when we borrow funds, it can be either general or specific. Okay? General borrowing means we have several loans. Now, when it comes to general borrowing, this means that the business already has several loans. Now, when you have several loans, this means that you already have the money. Now, from that money obtained, you are just taking a portion to construct the asset. This is what you call a general borrowing. But what about a specific borrowing? Okay? When it comes to specific borrowing, this means that we only borrow money because our only purpose is to construct the asset. Now, you must be able to differentiate general and specific loans. General loan means that we already have several loans. This means that from the money that we obtain, we are taking a certain part to construct the asset. While in specific borrowing means we are borrowing only for the purpose of the construction of the asset. Okay? Now, the treatment of a general and specific loan is different, and we will be going through it in a while. Now, sometimes when we borrow money, we do not fully utilize all the money at once. For an example, let's look at this scenario. Okay, Jaco borrowed $2 million at 1st January 2010 to construct a qualifying asset. Only $1 million was needed for the first 6 months. The remaining $1 million was invested, giving a return of 3% per annum. Jaco borrows funds at 5% per annum. Calculate the amount of borrowing cost to be capitalized. Now, when you see a scenario like this, where not all of the money is being utilized at once, what we do is, we usually can invest it in a different place. Why do we do this? Rather than the money is just lying in our bank account, we can invest it somewhere. Now, in this scenario, you can get a return of 3% per annum. Okay? So, can I say that I have an interest expense of $2 million times 5%? This scenario will lead us to an interest payment of $100,000. Yes, why? Because we are borrowing $2 million at an interest rate of 5% per annum. But if you see here, $1 million was invested for 6 months, and we got a return of 3%. So we actually borrow money, but we can actually get an income from it. Okay? Now, if you see here, only $1 million was needed for the first 6 months. This means the remaining $1 million, we could invest it for a period of 6 months. Why? Because it was not being used. $15,000 of investment income. Now, in this scenario, what do we do? Okay, IAS 23 requires us to net off any income received with any interest expense that we have to pay. Now, in this scenario, we have an expense of $100,000, but we have an income of $15,000. This means we are only going to capitalize $85,000. Okay, we are going to be capitalized. Okay, remember, when all of our money is not utilized at once, in certain scenarios you can invest it. When you invest it somewhere, you get income. Now that income you must net off with your interest expense. Okay, now let us look back at this question and see what type of loan is this. Is it a general loan, meaning we already have several loans? Or is it a specific loan, where we are borrowing money only to construct the asset? It says here, Jacob borrowed $2 million at 1 January 2010 to construct a qualifying asset. This means that you are borrowing money only to construct the qualifying asset. So this would be an example of a specific loan. Okay? Now, what do we do when it comes to general loans? When it comes to general loans or general borrowings, we have to calculate something called the weighted average capitalization rate. Now you might be wondering, what is the point of calculating this average rate? You see, when we have general loan, this means that we have several borrowings, or you can say we have few loans already. Now, when it comes to few loans, this means that we have different interest payments. Why? Because usually the interest rates differ depending on how long we borrow the money for and how much money are we actually borrowing. Due to that case, we have to calculate the average capitalization rate, or in simple terms, this is the average interest rate. Now, once we calculate this interest rate, we are going to base our borrowing costs with this interest rate. Now, to calculate the weighted average capitalization rate, we have a formula. Okay? To calculate the weighted average capitalization rate, we use this formula. Percentage of loan A times loan A over total loans, plus percentage of loan B times loan B over total loans. Now you might be wondering, what is total loans? Total loans would be like this. If supposing we have a loan of $30 million and we have a loan of $20 million, this means my total loan would be $50 million. Okay? Remember, we use this formula to find the average capitalization rate, or you can say the average interest rate. Now, let's do an example to make things more simple. Okay? Now, it says Capita had the following loans on 1st January 2010. Now, if you see, there are already loans available. There are two types of loans. One is a 9% loan, one is a 12% loan. This means that this is a general loan. Why? Because we already have these loans and we are simply just taking out money to fund the construction of the asset. Okay, this is $19 million, sorry. Okay, we have a 9% loan repayable in 2012 of $20 million, and we have a 12% loan repayable in 2016 of $19 million. Now, let's see the scenario. On 1st April 2010, $6 million was drawn out for the construction of a qualifying asset. This means from the funds that we have of $39 million, $6 million was taken out to fund the construction. And on 1st August 2010, an additional $2 million was drawn out for the same purpose. Now, in a scenario like this, always calculate the weighted average capitalization rate first. Okay, now how do we do that? Let's look back at our formula. It says percentage of loan A times loan A over total loans plus percentage of loan B times loan B over total loans. Now please note this formula can continue, but in general in this question we only have two loans. This is why that formula is applicable. Yes? So let's try calculating the weighted average capitalization rate. Okay? Let me do this. Now, let us look at our loans. We have a 9% loan repayable in 2012 worth $20 million. So I will name this my loan A. So I will have 9% times loan A has a value of $20 million. So it would be 20 million divided by my total loans. Now if you see, I have a loan of $20 million and I have another loan of $19 million. This means I have a total loan of $39 million. Yes? And how about my other loan? I will name it loan B. 12% interest rate times $19 million over $39 million. I have 4.62%. And I have 5.85%. This equals to 10.47, but I will round it up to 10.5% to make things simpler. Okay, this is my weighted average capitalization rate. This means I am going to calculate my borrowing costs on this figure. Now let's see. Once you calculate the weighted average capitalization rate, let's read the scenario. On 1st April 2010, $6 million was drawn out for the construction of a qualifying asset. Yes? Now, this means that, let's write here, borrowing costs. Okay, I will have a $6 million loan and I will be using the weighted average capitalization rate, 10.5%. Okay, now let's see, we are only taking out the money on 1st April 2010. Yes? Now let's assume the year end is 31st December, okay? Okay? Now if you think about it, from 1st April till 31st December, this is not 1 year. This is only 9 months. Hence, I am going to times it with 9 over 12. $472,500. This is the interest payment which I am going to capitalize. But it says on 1st August 2010, an additional $2 million was drawn out for the same purpose. Now, if you see from August till December, this is September, October, 5 months. Yes? So I am borrowing another $2 million at the same rate of 10.5%, and I'm going to times it with 5 over 12. Okay, that means the total amount I'm going to capitalize in the year is $560,000. Okay, now you might be wondering, why do we use this 10.5%? Why don't we use the respective interest rates, 9% and 12%? You see, as I explained earlier, when it comes to a general loan, we have different interest rates with a different value of each loan. When we use this formula, this means that we are already calculating the average. This is why we are going to use 10.5% to calculate our borrowing costs. Yes? So the amount to be capitalized in accordance with IAS 23 will be $560,000. Now, you might be wondering, when do we actually start capitalizing borrowing costs? Okay, capitalization start at the earliest of these three dates. One is the date of borrowing cost is being incurred. Second is the date where expenditure is being incurred. And the third one is the date where we're actually doing activities to prepare the assets for its use. Okay, remember it's the earliest of these three dates. Now, when does capitalization end? Okay, we will stop the capitalization of borrowing costs when the construction of the asset is completed. Now, there can be scenarios where during the construction there can be certain scenarios where we will halt or pause the production. Now, in a scenario where construction is stopped or paused, capitalization should also be stopped or paused. Okay? When construction is halted, or you can say temporarily stopped, our capitalization should also be paused. Yes, this is the end of IAS 23. Now let us quickly review again. Okay, IAS 23 talks about borrowing costs. Borrowing costs are the interest payments that we have to pay when we borrow funds. Now, IAS 23 requires us to capitalize borrowing costs, or you can say interest payments, when we self-construct a qualifying asset. Qualifying assets are assets which take time to get ready for its use, meaning it takes long to construct. Now, what if we actually buy an asset which is already fully ready? Now, IAS 23 is not applicable in this scenario. We cannot capitalize it if it is already fully ready. What we do is we will expense it off in the profit and loss. Yes, these are the few examples of qualifying assets. Now, when we borrow funds, it can be either general or specific. General borrowing means that we have loans already, and from that loans we are taking money to finance the construction. But when it comes in specific, this means that we borrow money only for the purpose of the construction of the asset. Now, from this example, we discussed that if we have any income, we must set it off with the interest expense that we have to pay. Okay? Now remember, in this example, this is a specific borrowing, sorry. Why? Because we are only borrowing money to construct a qualifying asset. Okay? When it comes to general borrowings or loans, this means that we already have few loans. When we have few loans with various interest rates and with various amounts of each loan, we have to calculate the average, or you can say the weighted average capitalization rate. Now, we have a formula of doing this. Now, we did this example. Now, if you see, we already have few loans. When you have more than one loan, this means that this is a general loan. Okay? In situations like this, always calculate the weighted average capitalization rate first. Now, once we have this figure, we are going to calculate the borrowing cost with this interest rate. Remember, when it comes to borrowing cost, dates are very important. Remember to apportion it based on the respective individual dates. An example, if this one says 1st April, yes, if our year end is 31st December, this means we capitalize 9 months. If it's 1st August till 31st December is 5 months. So we have to apportion it respectively. Yes, remember when I say capitalize, this means that I included in the cost of the asset. Capitalization starts at the earliest of 3 dates. Borrowing costs is being incurred, expenditure is being incurred, and the date where activities are done to prepare the assets for its use, or simply when the construction starts. We stop capitalization when the asset is completed. And when certain scenarios happen where we have to pause production, then our capitalization should also be paused. Okay? If you have any questions, okay, if you have any questions regarding IAS 23, please feel free to email me at viraj.john@lsafglobal.com. Thank you for watching this video and I hope to hear from you soon.